started actually in February of 21. We started declining. Truly disruptive innovation started declining in February of 21, while the market soared to all-time highs in 21, and now the rest of the market is suffering as well. So vaccine, people going back to work, supply shock. The businesses had shut down, wondering if they would ever reopen their doors, right? They shut down. At the same time, governments around the world were stimulating aggressively. So we had a supply shock, especially because demand actually was so much stronger than anyone expected. And I would say lessons learned. Could I have dreamed, a technology investor, that supply chain issues would have lasted more than 2 years? No, I never thought that for a second. I thought we would be over that in a year, and certainly couldn't have predicted Russia's invasion of Ukraine. So the question is this a 70s style inflation, which is how the markets are treating it right now, and why our strategy has been decimated, and most growth strategies have been hurt very hard. We don't think it is. I think the market's pricing is pricing innovation as though we have a bad inflation problem that's going to take interest rates up even higher. We don't think so. We think actually the greater risk and opportunity is deflation. I think we're going to start seeing deflation on a month-to-month basis. We're already seeing commodity prices come down. They've broken down, many of them. That's upstream, at the top of the pipeline. At the bottom of the pipeline, around the world, we're seeing a massive inventory overhang as we're heading into the holiday season. How will they clear that? Discounts. So I think cyclically, we're going to see deflation. We're already seeing it in the pipeline. Secularly, we will also see deflation. We spend all of our research time focused on disruptive innovation, technologically enabled disruptive innovation that is inherently deflationary, but that's good deflation, because as prices for electric vehicles continue to come down, we will see a continued boom in electric vehicles. It will hurt the internal combustion engine cars, but it will help the innovators. So I think we're going into a deflationary period, much like the late 19 teens. So 1918, World War I ended. Spanish flu also hit. So think about that. War, flu, very similar dynamic, right? And the other similar dynamic was 3 major innovation platforms that were going to transform the world: telephone, electricity, and automobile. They were all scaling exponentially and took us into the roaring 20s. So supply shocks took inflation back then to 15%, but within a year and a half, 2 years, that inflation started dropping, and it ended down. I'm sorry, the inflation was 20%. It ended down, deflation, 15%, roaring 20s. I'd like to think that's what we're going into now, and there's a high probability we are. So it's interesting to watch our strategy as fears about Fed tightening and more Fed tightening continue. On many days when the market's down, our strategies are up. Now, that is what tends to happen. I'm not promising this is where we are. My compliance department would never let that happen. But in the later stages of a bear market, our strategy starts to outperform. Even it may just be that we're down less than the market. Some days we're up when the market's down. Why? Because during the later stages of a bear market, the new leadership shows up and starts performing. We're the new leadership. We always are. And many people think, oh, I've got myself covered with the NASDAQ 100. No, look deeply into those indices. We are the new NASDAQ. And most of our stocks are not in those indexes. We haven't owned the FANGs in our flagship for quite some time. That's not the new anymore. TikTok has come along and destroyed a lot of models. So yes, I think that we're seeing the early stages of a bottoming process. At the same time, many people are saying we're going into a recession. Now, we think we've been in a recession, and that the negative numbers will reassert themselves after this positive third quarter, mostly because of the inventory overhang, and we need to clear that out. I think many forecasters may say, oh, this is going to last forever, this recession through. We think it's just a major inventory correction, and then we'll be on our way again.
So a short-lived recession is what you're forecasting?
Sure. Well, we believe it started at the beginning of this year. So if it ends in the middle of next year or the third quarter, it's not so short-lived. It's only short-lived given that, you know, that many people in a midterm election year don't agree that we're in restoring for the entire existence of our firm. We started our funds in 2014. The number of risk-off, risk-on periods we went through during that period up to COVID was quite astonishing. That low interest rate, negative interest rate did not do what most people think. It just didn't. They're ascribing the massive increase that our strategy saw in 2020 to low interest negative. No, we're going to say no. Innovation solves problems. COVID-19 created massive problems. We needed to sequence the virus to understand how it worked. We needed to develop tests. We needed a vaccine. So no wonder that our genomic revolution strategy was the best performing strategy during that period. Innovation solves problems. We needed to digitalize everything we do. Work, play, healthcare, education, and that innovation helped. Now, what has happened since then, because many people think that that burst, and from the low in COVID, April of 20 to February of 21, our flagship strategy was at 360%. Now, innovation solves problems, but by the end of all of that, we were saying, okay, keep some powder dry, you know, because our minimum hurdle rate of return for any stock to get into the portfolio is a 15% at a compound annual rate for the next 5 years. We hit that in February of 21. Now with the massive downdraft we've seen, our rate of return expectations have never been higher. I've never seen them higher in my career. Cannot tell you what they are because compliance, of course, has a lot to say about that. But as you said, being down 75% plus from that February peak, when innovation is still solving problems, and we have so many more problems than even during COVID. We have the war, we had all the supply chain problems, and we have a recession, which is going to force most companies to say, how do I increase productivity? How do I cut costs? Technology is usually the answer. So I think we're coming into a moment, hopefully many moments, where innovation is solving problems and our revenue growth rates are going to surpass by far the revenue growth rates that very interesting. I think you may know that we wrote an open letter to the Fed saying, wait a minute, how can the 12 of you unanimously agree on 75 basis points at, you know, one right after the other when commodity prices are falling, inventory overhangs are crushing companies, and so you have upstream deflation. We believe downstream there will be deflation. There's no debate over this? Are you kidding? Do you know that in the early 80s, and I was fairly new to the business, Chairman Volcker was fighting a 15-year inflation problem. It started in 1964 with the Vietnam War and the Great Society. So 15 years, and people were used to inflation, so they were demanding it in wages and so forth. He took interest rates up twofold, 10% to 20%. This Fed has taken interest rates up roughly 16-fold in 9 months. Now, economics takes place at the margin, changes at the margin in all kinds of pricing, and interest rates are prices. Changes at the margin are incredibly impactful. And I think we will look back in history and say, wait a minute, a 16-fold increase in 9 months without stopping to see what's happening is crazy. It's crazy. And this is, though, this is what will take inflation from up